Today we're looking at a company that claims to be the European alternative to the American giants like AWS, Google and Azure. Based on the math and the industry, I think this has a solid chance of becoming a 10-bagger or even more. The company is called OVH Group, or also known as OVHcloud, ticker OVH. For years, investors have been looking for a way to play the cloud boom without paying 50 times earnings for American tech stocks. On paper, OVH looks perfect. They built their own servers, they have data sovereignty protections that governments love, and they are growing. But when you dig into the financials, you will also find a story of massive capital expenditure, a debt, owner problems, and a struggle for free cash flow. On the other hand, these are minor issues in the long run if they succeed in their mission. Today we're going to tear apart their annual reports, look at their debt structure, analyze their Capex, and figure out if this is a hidden gem or a value trap. Overview. First, what does OVHcloud actually do? They are a hyperscaled cloud provider, but they do it differently. Unlike competitors who buy servers from Dell or HP, OVH builds its own servers in its own factories. They use a proprietary water cooling system that reduces energy costs. This industrial model is their main competitive advantage. It allows them to offer cloud services way cheaper than the big US players. They make money from three main segments. First is private cloud. This is their biggest moneymaker, accounting for about 60% of the total revenue. You can imagine this as renting a whole house for yourself. You rent an actual physical computer, a server, all to yourself. You don't share walls or resources with anyone else. It is secure, private and powerful. Second, we have public cloud. This is around 20% of the revenue. Think of this like staying in a hotel. You share the building's infrastructure, electricity, plumbing with other guests. It is flexible, but if you suddenly have a lot of visitors, you can't instantly rent 50 more rooms just for one night. Lastly, we have web cloud, around 20% of the revenue. Think of this like renting a mailbox. It is the basic utility every business needs to exist online. Their website name, domain, and their email hosting. It's small, steady money. Next, we have the competitors. OVH is fighting a war against giants with infinite pockets. Let's look at the market share in Europe. The big three are AWS, Azure, and Google. Combined, they control roughly 70% of the European cloud market. And OVHcloud, they hold a much smaller slice, estimated around 2 to 3% of the European market, though they are a leader among European native providers. Geographically, OVH is heavily dependent on its home turf. About 48% of their revenue comes from France, roughly 29% from the rest of Europe, and about 23% from the rest of the world. Lastly, we have to talk about the ownership factor. This is because the company has a tight ownership structure. The founder, Octave Klapa, and his family still owns roughly 70 to 80% of the company. This leaves a float of only about 30% available for public trading. This is a major impact on the stock. First, the liquidity is lower, meaning the price can swing widely on small trading volumes. Second, it means that as a shareholder, you are essentially a passenger in the Klapa family's car. They hold all the voting power to decide the company's future. Now let's move on to the financials. Now let's look at the numbers. Market cap is around 1.5 billion euros or $1.7 billion. P/E ratio here is meaningless as they have barely broken even on net income basis. They are paying zero dividend and short interest is low, partly because of the float is also small. And here's the 5-year revenue history. They have consistently grown the top line revenue, around 13% CAGR growth. In 2025, they finally broke 1 billion euros. I think the most interesting thing to focus on here is Capex. I think this is where the market gets it wrong. Investors see a company spending 360 million a year and panic. But we need to split this into two buckets. The cost to stay alive, the maintenance, and the cost to grow, the growth bucket. Here you can see the 5-year Capex split. Just look at the maintenance line. It has flattened out around 130 million for the last 3 years, even while the revenue grew from 800 million to over 1 billion. This proves that their industrial model works. They are squeezing more life out of their servers. If they decided to stop growing tomorrow, they would save around 227 million in growth Capex, and their free cash flow would instantly rocket into the positives. They aren't burning cash, they are choosing to reinvest it. But there is a small hidden problem: diminishing returns. This is a small red flag. Here we compare the money they spent on growth Capex in 1 year to the actual revenue growth they got the next year. This model isn't the best and has many problems, like only checking 1 year's statistics, but in general it works roughly. And here's the verdict: they are spending more money each year to generate less new revenue. In 21, their machine was efficient. Today they have to spend twice as much to buy the same amount of growth. This suggests that the European cloud market is getting saturated, or the competition is forcing them to lower prices. But as I said before, this year-over-year comparison isn't the best, because $1 reinvested can bring bad returns on the first year and maybe bring better returns on the years after that. But unfortunately, we don't have enough data. Now let's look at the debt. Their net debt has been climbing as they borrowed to fund this Capex. In 2021, they had roughly 350 million in debt, and 25 they have roughly 650 million in debt. Debt to EBITDA is currently sitting around 1.5 to 2x. It is manageable, but it restricts them from making big moves. Now let's move on to the future. So what is the end game for OVHcloud? One bull case here is the sovereignty hope. The biggest tailwind here is geopolitical. The European Union is waking up to a nightmare. Their public data, meaning health records, military comms, government files, is sitting on servers owned by the American companies. The EU wants this data back. The sovereign cloud market is projected to grow from 27 billion to over 190 billion in the next decade. If Brussels mandates that the sensitive data must stay with European companies, OVH is the default winner. But here's my honest opinion on the future. I see a massive divide between the private data and the public data. I do not think OVH has a chance in the public data market, where you share a server capacity like a hotel. Cap is just too wide. Competing with AWS or Azure on the features and AI tools is impossible when your entire company's valuation is pocket money to them. They will crush OVH on price and innovation every time. However, I think they can win in the private data market, where your info is more secure but only under one specific condition. It all depends on how hard the EU wants to be. If EU is satisfied with the data just being stored in Europe, even if owned by American companies, OVH loses. But if EU decides that data sovereignty means that the data must be held by a European-owned company inside Europe, ensuring that the US government can never subpoena it, then OVH becomes the only game in town. You are betting on European politicians finally growing a backbone. But while their words have gotten louder lately, their long-term track record suggests that in the end they may back down yet again. Now let's move on to the intrinsic value. Now, because of the company isn't producing any cash flow, we have to use different valuation methods for the company. So let's evaluate the company using two very conservative methods. First method is that we're going to assume that they stop trying to be a growth stock and just focus on making money. So imagine OVH decides to stop expanding tomorrow. No new data centers, no market share battles, just maintain their existing servers and collect cash. In 2025, they spent 227 million on growth capex. If they stop growing, that money stays in the bank and becomes net income. And since they stop growing, we have to assume that their growth rate will take a hit. So we cut their growth rate to just 2%, basically inflation. Because of this low growth, we slashed their PE multiple to just 10 PE, treating them like a boring utility company. So the valuation comes to 225 million times 10 PE equals 2.27 billion market cap. So even with this pessimistic no growth view, the company is worth 50% more than its current 1.5 billion price tag. Now let's look at another method for evaluating the company. We can start looking at the profitability. The big three, AWS, Microsoft, Google, operate at roughly 30% operating margins. Let's just assume conservatively that OVH is structurally inefficient and can only achieve 40% of the profitability of the Americans. So 40% of this 30% margin is 12% operating margins. Here's the math. On 1.08 billion euros in revenue, a 12% margin gives us roughly 130 million in operating income. Because in this method they are still growing, we may apply a standard 15 multiple to that income. With this, we get a market cap of roughly 2 billion. So the upside is still roughly 30% from today's price. So what is the final verdict? It's a classic mixed bag. On one side, you have the brutal reality of the market. In the public data sector, OVH is essentially bringing a knife to the nuclear gunfight against Amazon and Google. We have seen their capital efficiency drop, meaning they're burning cash just to get less growth, all while carrying a heavy backpack of debt. But when you look at the price tag, the story flips. The market has priced this company as if it is destined to burn cash until it hits zero. As we calculated, if they simply survive, if they just stop the aggressive expansion and focus on cash flow, the stock is worth double what it trades for today. I think ultimately, this trade comes down to one specific bet. Can they hold the line in private data sector? Will EU leaders actually insist that the data is in EU company as well? Even if they lose the public wars to the Americans, there is likely enough runway in the government and sovereignty market to keep the lights on. At this valuation, they don't need to become the next Amazon to make money. They just need to grow a little and not go bankrupt. If they can manage that, the stock is massively undervalued. But as always, this is not investment advice. Do your own research. Well, what do you think? Is this going to be the next Demberger? Do you think the EU leaders will insist that their sensitive data must be held in a European company? Or will they back down on those claims? Comment below what you think. Also hit the like and subscribe for the algorithm. And as always, do not lose money and safe travels.